G'day all, Ben here East West. We're going to have a weekly dive into uranium as we do. Look at three names this week, Energy Fuels, Denison, and also going to have a look at UEC because I think that is really on the radar at the moment. So let's jump into the charts. So just starting off here with Energy Fuels, and this has been the main downtrend that we've been wrestling with since way back here in sort of mid-September last year, and the swing pattern that's emerged through this period that we haven't yet defeated. So we've been observing this big rally that we had here. So this is the good start because we took out this high, which of course was important for the structure itself. And now, of course, we've dipped back down. And so this formation looks kind of what you'd want to see, I think, if you're looking for that long-term rally. So for me in the short term, this is quite an important pivot, only because we've had the shrinking of the downswings as we can observe here on the chart. So 31 days, that was 24%. This one was 29 days at 29%, a little bit bigger. But then we had just 18 days at 25%, and this time we've had 7 days at only 19% down. So on the flip side, we can see here we had 14%, 14 periods with 20% rally, and then the next upswing has been 22 periods with nearly a 40% rally. So what I'm getting at is it looks like the swing structure is flipping over in terms of we're starting to get maybe possibly here a larger swing up and a smaller swing down. So of course what we want to see from here is another swing that possibly is going to be bigger than this swing. That would be the ideal scenario. And of course then we've got the connotations of coming through and breaking out of the trend channel to establish our new uptrend. So looking at that, there's a little bit of a here where we've just slipped through the retracement. It would have been nicer if we held. But the one phenomenon we can see here, of course, is a trend that terminates into a trading range. So what we really want now is for this to hold. It goes without saying, and that to move up to take on, I wouldn't say this measured move is dead, but to take on the first target, possibly even up to the second target in a measured move sense, to really consolidate the swing pattern going forward. Now, I've got to also highlight, of course, the danger here, and the danger would be that this is the first leg of a three-legged correction. This becomes the consolidation leg. Then we get the third leg back down. Now, if that was to eventuate, what I would expect off at least the current high would be some sort of, if this was going to be the top, some sort of one-to-one move. So something down here that would more than likely take this out. So we don't want that to happen. But I think you've also, you've got to highlight the downsides because I don't think enough people who analyze uranium on social media take any note of what can happen to the downside. So that would be the downside scenario that I'd be concerned about. But it's not. That's not my primary case. I am expecting this to find its feet, and I really do want to see it go on, but I'm aware to the fact that it could go down like that. Now, the one thing I've observed here, which has been very helpful, has been where this RSI has bottomed out. So it's bottomed out just about at 40, okay, on this downswing. So for me, when I see that, it's just another little confirmation that the market's starting to go into a bullish mode, okay. So I would read the RSI. Look, you can't put too much weight into any one thing, as I've said before, but you just put all the signs together. So we're chopping with bit of support here at the resistance zone. The RSI is holding 40, which means that the momentum on the way down out of the last 14 bars has run out. As you can see here with the way that these candles are chopping, that's what's held the RSI up. So now we just want to. So you can look at the cycles of the RSI. Where we went up to here, we topped out, and what happens next? We get a cycle that goes, we talk about the top, the cycle that goes down, we've bottomed out. You can see where that the line here is. So, now I'm expecting the next cycle back up. That's just the expectation. But, I want to see, as the swing structure develops to being an upswing, I want to see the RSI holding that level like so. I think I've mentioned that before in previous videos. The next thing I'll note is I just bring in a bit more sort of confluence into the view is just looking at this daily Ichimoku. So we had, I know it looks a bit confusing, but we had this long stretch of red cloud, which really showed us the strength and the overall trend down. That's what that means. But we've gotten through it, which is great. But I kind of like the way, and this is why I really want this to hold its feet. I like the way it's just holding this cloud now, and I really want it to now start to break higher. Okay. Because as I've said before, the Ichimoku cloud, all it really does is tell us when enough time has gone by for price to break trend and start to continue on. So that would be my expectation moving forward, is now you'll see this cloud, staying green and starting to grow up if this trend can keep going. So that is still what I'm anticipating is happening here. But once again, always aware of the danger that we can slip away again, because nothing says we can't. So you've always got to be aware of that. It's not just bull party, 100% of the time. It can't be. Okay, things go up, things go down, and this has been proof. It's been in a downtrend for a long time. But the point here is that now we're starting to see those emerging signs of potential uptrend coming in. Finally, with energy fuels, this is not 100% clean, but you can sort of see here there's a bit of an inverse head and shoulder pattern going on here. Now, obviously, it would be better if this was flat, okay, but it's not. But nonetheless, it's not a bad formation really. You've got this shoulder, you've got the head. It's not quite a double top, but it was like a bit of a fake break, right? Then the right shoulder and the left shoulder are almost sort of at the same level. So when you sort of put that together, it's kind of like, okay, well, yeah, that kind of goes together, and you put it together with all the other stuff we're seeing, and it's just another bit of confluence. Now, if this head and shoulder pattern was going to play, which so far it looks okay, the target for this pattern would be sort of up here around sort of $9.16, call it. So that's a fair way away. I mean, there's going to have to be a fair bit go on to get up to that, but you can sort of see that, okay, well, if we get that trend that we're looking for, and we're just reading the signs that this is ongoing, well, that could be something to consider going forward, because, what would that line up with? I mean, you're probably talking about then, the resistance around the top of here, okay, around this $9 area, and you could probably go even further back, and what would that sort of encompass, this sort of area? There's not a lot there, but I think you get the point, right? There's a bit lining up there if this was going to play. So, reasons to be optimistic here, but always be aware of that danger we can slip away. Okay, just moving on to Denison here. We're just going to start on a weekly. So, the structure that I've been looking at, or the main sort of pivot area I've been looking at through here for obvious reasons. Okay, so I mean, maybe it's reaching a little bit when you sort of look back at this structure, but this was obviously a major point. Okay, and this was, of course, the November 21 high. So when we look back, I mean, it kind of ties into a bit of what was going on there. But what I kind of liked is just moving forward, if I just expand this chart out, and what we're sort of seeing and what we have seen, of course, is the rally, the test, the break, and now it just looks like we're kind of retesting. Okay, but so just in the long term, there's another really good structure that goes with this Denison weekly chart, which is, of course, the measured move. So, this was a great run, but the fact that we've just sort of held this 61.8 would lead me to think that, the measured move target up to $2.60 is still valid, and it hasn't been reached yet. However, we have broken the top, so that keeps me a little bit wary. So just generally, there would be an expectation we can get there, but, we might fall short of target. However, that's still a profitable trade. But Denison, for me, a little bit, I remain a little bit wary, and I'll go over why. Now, I'm just here on the daily, and I've just drawn this sort of trend channel as the major sort of uptrend support, but we're just in here testing it again, and, there's only so much you can fatten this out before you start to kid yourself, because you start going, oh, look, it's holding, well, maybe you could even make an argument that, it's like that, okay? But I think the point is here, this is starting to look a little bit deeper than what it has. Now, the problem I've got with Denison is it was a great run, but it never really retraced to the extent that everything else did. So, while ever that remains the case, I'm a little bit wary of the possibility of doing that, okay? Because after such big runs, I just need to see some digestion and retracement before I get more confident that some sort of bottom's in. Now, I'm not saying this will happen, but I remain cognizant of the fact that it could, and maybe that comes in and just wicks down to here. That would be that's how I would see this as being dangerous. And the thing here with Denison, like if this was going to be a three-legged correction of the overall run, which is something that happens reasonably often, the one-to-one move, if this was going to be the top, puts us right back into that 50 zone, and would certainly come in to challenge this. Okay, so that, the expectation or the anticipation of that, I'm not saying that will happen. I'm saying I'm very aware that that could happen. And I think you should be too, especially if you're a Denison holder, because, there's reasons to be optimistic long term, but you've just got to think, well, I'm sitting here right now. It's sitting at $2.02 as we've closed today. How am I going to feel if it goes down to $1.70? If you're fine with that, hey, you got no problem. Maybe you want to buy more, or maybe you're looking for an entry. I mean, you got to do it any way you want. But all I would say is I'm wary of the fact that this needs to retrace and just digest, and it hasn't really done it yet. It's been a pretty uninterrupted run back up, so that makes me somewhat wary on this one. Even just looking at the RSI, you can sort of just see it starting. I'll just sharpen that. You can see that starting to diverge away as we peaked out here. Okay, so it just means, for me, the momentum of the bullish movements are running out. So the bullish candles are not holding much sway. Now, it is very fair to say, and it is very true, that this series of candles that we've had, which were much more strong on the downward side, have tipped the RSI over, and that is true. But the RSI is also now starting to fail through 40. Okay, so I would expect in a bearish sort of market, I'll try to move that out of the way so that doesn't get in the way. In a bearish market, we're going to get much more push down here into the, I'll just have to tighten that up, much more push down here into the oversold area. Okay, that's what I would expect in a bearish market, and then topping out at 60. So you would see more of that, which would, bring us down into this sort of retracement zone. So that is what I'm wary of with Denison. And just finally on Denison, I'm just going to bring up this ratio chart, which I know become popular, but to me, I think there's some use for them, but they're a little bit limited. I think you got to be very, very careful about using ratio charts just to prove a point to yourself, so you can see what you want to see. Now, I've just compared Denison to URNJ. Reason being, these are the daily holdings of URNJ, and Denison, of course, is strong in it. It's 11.85% of the ETF. So, what we can see is that Denison has really outperformed, okay? But, we came down here big time, okay, because everything else suffered and Denison didn't. So what I'm suggesting is, there might be a bit of catch-up now in this relationship. And now, potentially, you can see all through here, we never really got much, but potentially here now we're starting to swing back up as URNJ and its peers start to outperform Denison on the upside. So that doesn't mean that URNJ is going to rally. It just might mean that Denison's going to fall further away. Okay, it's going to fall further away than what the rest of the holdings in the ETF are. So I mean, that's all it really says. But I just put this together with what I just showed you, and I remain wary about Denison and further downside potentially emerging there. Okay, now just to finish off here, on the flip side of that, I want to look at UEC, because I think this one is super duper interesting. So the last time I looked at this was back on the 1st of June. So this is where we left it. And for any of you who watched some of my videos or got that far, you'll know that I've sort of noted that we had this wedge going on here and that it was looking very close to wanting to break out. Now, I don't want to rain on anyone's parade, which is why I said yes, it could do that, but I sort of made the case, or I sort of suggested that an Elliotician would suggest that this is what was going to happen. And that was the most likely scenario and more likely path for price. But I don't think I emphasized that strongly in the video, but I did say that that would be the expectation from an Elliott perspective. So I'm just in bar replay here, so let's see what happened. Okay, so that, we broke out. Okay, now we're in a line chart, remember, and I did the line chart because in a line chart you can see here that the wedge was much more. So this is indicative of the closing prices, but the wedge was much more stark. But when we bring this back into a candle, you can see here that we didn't quite get to that retracement. But what did we do? We made a near perfect one-to-one move. Okay, so what happened here is the length of this swing projected off the top, the highest point of the wedge, we moved almost exactly one-to-one. Okay, so I'm looking at that going, okay, there's a box ticked. We've got the 50% retracement of the large swing, which we didn't quite hit, but, we're in the zone, okay, with a little bit of structure there. I wouldn't have said it's massive, but, there's always something you can lean on going forward. I think the question now remains, has this been enough to balance out that? Well, it's early days to tell, but we just got to look at the signs of what we can see. So, what this green panel represents is 50% of the time of the rally from here. Okay, so the whole from May 2023, where we really took off, all the way to the 1st of Feb 2024, where the rally sort of ran out of puff. We've gone through 50% of that time. Okay, so we've corrected 50% in time, which is not a bad thing. We're into the 61.8 quartile now. But the point being that time-wise, that looks pretty good. It looks okay. There's no hard and fast rule there, but this looked too short. So when you're talking about balance, you don't have to have a one-to-one in time. But if you go through half the time correcting the rally, that's probably not too bad. You're on the right side of it, is what I would suggest. Now, just to balance, we did come down here into the oversold area, but we don't have any daily divergence, so that keeps me a little bit wary. Maybe that means there's one more low, but we've just got to wait for signs. So we had the better earnings here, which has probably also helped things. But it's now about, for me, I'd just be looking at what's happening inside here. Okay, so that would be my next focus. Now, I think the main danger you've got here in the short term, we're just down here in a 4 hour. The main danger you've got here in the short term is that Elliott hasn't steered us too wrong here, but there's definitely a case to be made that this is 1, 2, 3, 4, and then we've just got a fifth coming down. I don't know if that's going to happen. You could maybe make a case. I don't know. I'm not going to lean into an impulsive move here. I'm just going to rely on my retracements. Okay, so what I'm seeing is you could maybe take this pivot. I'd probably take the break from the breakdown. We haven't quite got back to test here, but that's what I'm looking for. However, the way this is shaping, because of that larger picture, I'm a bit more interested in looking for this. Okay, I'm looking for the move. This would be a more aggressive way to play it, to look for a buying opportunity here, to look for the uptrend to start to establish. Okay, that would be the aggressive way. You'd have to put your stop below here, and that remains problematic in that Elliott structure, that we might just have one more. Okay, so pick what you want, but that's how I would play it personally. The safer way to do it would be to observe that from the sideline happening first, so you got that. Okay, and if you got something like that, then the next play, of course, would simply to be wait for the next retracement. Hopefully it lines up with whatever. The danger with doing this is you might get an extended push with no retracement, and all of a sudden you're back up here and you'll feel like you've missed the boat and you're buying at the wrong time. So you've got to decide how you want to play it. That's completely up to you. But what I'm saying is that this is making good signs that it wants to put a bottom, that this is got good potential to be a major low. That's how I would look at it. I mean, even just looking at this, these these are 4 hour Keltner channels, but the fact that we've got free bars here that align with a volume spike or a volume peak, even though you can say, oh, what about this one? Yeah, well, that's true. But take it all together then. I mean, you can maybe you can aggregate all that because this peak would come off, well, that's off that one. But the fact that you've got it looks like what I'm getting at is that looks like a good case for, move this out of the way, it's really annoying, a good case for a selling crescendo, like a selling climax. With this volume peak and drop off, someone's bailed out here, right? And they're probably sorry they did. So free bars on the Keltner, bars pretty outside the Keltner channel with a volume spike. That also is another sign that that's a blow off, or good potential for a blow off bottom. And now even looking, I'm just going to finish off here with a ratio chart, but done around the other way. So I'm going to look at this shows UEC being strong against the URNJ constituents. And once again, I've used URNJ because UEC, of course, makes up 10% of that. So I'm just looking at the relatives. I mean, you could use URNM if you went. This is URNM, but of course, this is only 4.8% because everyone wants Cameco. Nonetheless, that's why I'm using URNJ rather than URNM, but it would look similar in terms of the chart. But here we are, and we've just observed UEC badly underperform in a three-way corrective one-to-one move, and it's come right down into the retracement zone, and then it's had quite a strong ricochet away. So, that would just suggest that on the rally, that UEC to me is primed to outperform URNJ. Again, looking at it like this, what would you be looking for? Well, personally for me, I would just be looking for the retracement. And then if it got down into this retracement zone and UEC itself retraced, then you could stop and think, okay, well, how do I structure up a trade here? Where's my risk? Where's my profit? How am I going to manage it? Whatever you want. But that would be personally what I would be looking for. So there's a couple of things here that mirror the UEC chart. So the first thing to really see here is just, and this is a daily, right? So when you're talking about Keltner channels, you don't often get daily bars, daily free bars, daily bars outside the Keltner, but we got it here right into the 50% retracement. Coupled with that, even though it's not outstanding, we still got a bit of a volume spike on the day of the bottom. Okay, so that to me would just suggest that it's got potential to be a blow off bottom. Okay, and even though this is sort of, that's good volume, but the market hasn't fallen hugely. Like, it's not a massive red candle, right? So take that with a bar of salt, because these were good green candles. So to close out the week, maybe people were taking profit in UEC. So look, just to finish off here, what I will mention is you've got to be, and this is the other reason you've got to be a bit careful of these ratio charts. They tell you one thing, but no one's trading this. Well, look, put it this way, I'm not very confident about much in markets because I've been around long enough to be humbled by them. But what I would be reasonably confident of is that no one's trading this. This is just a representation. Okay, there's not actually, there's probably a little bit, but there wouldn't be serious money flowing in and out of this spread. So what I'm saying is there wouldn't be people going long UEC and short URNJ. I mean, there probably is, but not in huge amounts. Okay, so representation only. Take all this with a grain of salt, and especially when you see it against the S&P or gold or whatever. I know a lot of people do it, and I'm not saying it doesn't have value. I just say be wary about the picture it's painting, because I think its applications are a little bit limited. So look, that's where I'll leave it. So just to wrap it up, Denison looks like a bit of an underperformer, but UEC I think is making the case to outperform. So look, thanks very much for watching. I'll see you next week. Bye for now.